Welcome to EduRev.
Hello all. In our previous two sessions, we discussed about what is accounting, its importance and objectives. Also, we have overviewed characteristics of good accounting information and advantages as well as limitations of accounting. So now we have got a fair idea about accounting. Moving ahead, now we need to study how exactly accounting is done. For this, we need to identify and record the business transactions in the books of accounts. Hence, we must learn what are the basic terms used in accounting. It is like accounting dictionary where we will understand which terminology is used to define the particular event and the meaning of those terms. So let's start. We saw that when Mr. Raj started his business, he had spent lot money to kickstart his business. Initially, there are no sales and there are no funds in the business. Then from where these payments would have been made? Definitely Mr. Raj would have invested some money in his business, correct? So this amount which is invested by the owner in the firm is known as capital. Now there can be possibility that Mr. Raj had an extra chair or computer at his home. So he brought the same in the business rather than buying from outside. Here the chair and the computer brought into business would also be termed as capital. So capital can be brought in form of cash or goods or assets. Just the way the owner brings capital into the business, it is possible that he might withdraw some cash or goods from the business, right? Say Mr. Raj has to attend a party of his friend and he wants to gift him a shirt. Then rather buying from any other store, he might take a shirt from his business only and give that to his friend. Possible, right? But how this will be accounted? Here, the shirt was taken for personal use of the owner and such activities are known as drawings. So basically, withdrawal of money or goods or both by the owner from the business for personal use is known as drawings. We have seen that the money brought in by the owner and withdrawn by the owner is recorded separately in the business books. So this brings to a term called entity. Here in our case, Mr. Raj's shop will be treated as an entity. So the business entity means a specifically identifiable business enterprise like sole proprietorship business, partnership business, a company, etc. And these entities have separate existence from their owners and hence we prepare separate financial statements for it. Now, Mr. Raj deals in clothes and in accounting, these clothes will be treated as his goods. Basically, goods refers to the products in which the business is dealing, that is, they are meant for sale. Over here, do remember that if the products are purchased for own use or consumption in the business, then they are not termed as goods. So when Mr. Raj purchased furniture for his business, it is not goods for him since it was to be used in his shop, but at the same time, for a furniture dealer, chairs, tables, etc. are goods because he is dealing in the same. So when the products are bought for the purpose of resale or manufactured and then sold are known as goods. When Mr. Raj started his business of ready-made clothes, he first bought the clothes for resale, which we term as purchases while accounting. And now the purchases can be cash purchase or the credit purchase. When the goods are purchased and immediately cash is paid, then it will be termed as cash purchases. But if the goods are purchased on credit, that is the payment to be made on later date, then it is termed as credit purchases. So after purchases, when Mr. Raj sold the clothes to the various customers and earned income, it will be termed as sales. Again, similar to purchases, sales can be cash sales or credit sales. Now can you tell us the meaning of these two? Simple, right? When the goods are sold and cash is received immediately, it is termed as cash sales. And when the goods are sold on credit, where the customer is going to make the payment at the future date, it is a credit sale transaction. Now it is possible that whatever goods purchased by Mr. Raj has not fully sold. There may be some goods left to sold at the end of the year. So such goods are known as stock in accounting. The stock or the inventory is a measure of something on hand like goods, spares and other items in the business. The stock which is calculated at the end of the year is known as closing stock, and this stock becomes the opening stock at the start of the next year. So friends, that's all for today. These were some important terms of accounting. In our next session, we will be covering some more important terms. So stay tuned with us. After completing this video on basics of accountancy, you can enhance your conceptual learning through notes and tests prepared by our expert teachers through EduRev Infinity. We have 5000 plus questions and 1100 plus documents created for you to learn the concept and practice the problems so that it helps resulting increasing your scores. With EduRev Infinity, you can access every primary subject of your class. So keep watching our further videos and let's enjoy this journey of accounting in a very interesting manner. Thank you.